If I gave you access to your financials right now, there's a very real chance your profit margin is completely wrong. Not because your business is broken, but because your bookkeeping is. Let me show you what I mean. You log into your bank account and you see 40,000 hit from Shopify. And your first thought is great, that must be sales. But here's what the number actually includes. There are fees pulled out of that. There are refunds pulled out of that. There are taxes sitting inside that number, and sometimes there are even adjustments from prior periods baked in. So that $40,000 deposit, that's not your sales. It's a summary of a bunch of different things happening across your business, some of which don't even belong in that time period. And this is where most e-commerce bookkeeping starts to go wrong, because your bank account is telling you one story, but your business is telling you another. And if your bookkeeping doesn't separate those two things properly, your numbers can look completely clean, completely organized, and still be wrong. In this video, I'm going to show you how your e-commerce numbers can look completely right, but still be wrong. The most common bookkeeping mistakes that quietly distort your profit margins and what you need to fix so you can actually trust your financials and make better decisions. Now, the first mistake, and this is by far the most common one, is treating deposits as revenue. This usually starts really innocently. You see money hit your account and you just call it sales. Because that feels logical, right? Money came in, my business is working, but here's the problem. What e-commerce platforms send you is not your sales. It's your payout. And these two are very different numbers. That payout is net everything that happened on the platform. Fees are already taken out, refunds are already taken out, taxes are sitting in there, discounts are baked in. So when your accounting software just records that lump sum as income, you're not actually recording what happened in your business. You're recording a summarized, blended number that hides all the detail that actually matters. This is exactly what a lot of integrations do by default. They just dump that net deposit into QuickBooks as one line, which means you lose visibility into what your true sales were, how much you paid in fees, how much you refunded customers, how much tax you actually owe. And if you don't have those broken out correctly, you don't actually know your revenue, which means you definitely don't know your profit. So the fix here is making sure your systems separates your gross sales, your fees, your refunds, and your taxes, and ties all of that back to your payout. Because until you do, everything downstream from revenue is built on a number that isn't even right to begin with. This next mistake can literally double your revenue on paper. And the scary part is, it looks completely normal if you don't know what to look for. Here's how it happens. Your platform records $100,000 in sales. Then your bank feed pulls in deposits, and instead of matching those deposits to sales, you categorize them as income. Now your books show $100,000 from your platform and $100,000 from your deposits. And just like that, you're showing $200,000 in revenue. Everything looks fine. Your bank is reconciled, your reports look clean, but your numbers are completely wrong, which means you could be making decisions based on inflated numbers, thinking your margins are better than they are, paying taxes on income that never existed. The issue is simple. Your deposits and your sales aren't connected. Deposits shouldn't create revenue. They should be matched to it. Because if deposits and sales aren't tied together, you're probably double counting. Now, this is where things get subtle. Most people think they have a categorization problem, but they don't. They have a timing problem. Let's say you do $100,000 in sales in June, but $15,000 of refunds hit in July. Your books follow your bank. June looks amazing. July looks terrible, but nothing actually changed. Those refunds belonged to June. They just showed up later. And this happens constantly in e-commerce. Refunds, chargebacks, adjustments, they don't hit when the sale happens. They hit later. So if your books follow cash instead of activity, your profit will swing all over the place. And you didn't change your business. You just moved your profit. The fix is tying your numbers to when transactions actually happen, not when payouts hit your bank. This is one of the easiest ways to fake your own growth. Sales tax is not your money. You're collecting it on behalf of the government. But when it gets recorded as revenue, your income goes up, your profit goes up, your margin looks better, your business looks healthier, but it's all built on money you don't get to keep. The fix is simple. Sales tax should sit on your balance sheet as a liability, because if your revenue includes money you owe someone else, your profit margin is already wrong. If your margins look amazing, this might be why. If you have 100,000 in revenue and no cost of goods sold recorded, your books show 100,000 in profit. But if your actual cost was 60,000, your real profit is 40,000. That's not a small difference. That's a completely different business. And this happens when cost of goods sold isn't recorded, or it's recorded late, or inventory isn't tracked properly. So your revenue is real, but your costs aren't keeping up, which leads to bad decisions. Overspending on ads, over-ordering inventory, thinking you're more profitable than you are. If your costs aren't in your books, your margins aren't real, period. This is where accounting starts to feel a little weird, because the same purchase can affect your profit in completely different ways. If you expense something, your profit drops immediately. If you capitalize it, it gets spread out over time. Same purchase, different results. And the mistake isn't just getting it wrong, it's being inconsistent. Because now your profit isn't just reflecting your business, it's reflecting how things were classified. So two identical businesses can show completely different profit numbers. The fix is consistency. Understanding what belongs on the income statement, what belongs on the balance sheet, and applying those rules the same way every time. Because profit isn't just what you earn, it's how you classify what you spend. Automation makes bookkeeping easier, but it doesn't make it accurate. Transactions come in, the system suggests a category, and you accept it. But behind the scenes, deposits get recorded as income, fees and refunds get buried. Transactions go to the wrong place, and because it's automated, it happens fast. So instead of fixing errors, you scale them. Everything looks clean, but it's built on bad data. So the rule is simple. Don't just categorize and match. Review what the system is doing. Because software doesn't fix bad accounting, it just hides it better. And this is how all of this shows up in real life. You look at your bank account and you think your business is doing fine. There's money there, sales are coming in, but your bank account doesn't tell you if you're profitable. It tells you how cash is moving. You can have cash and not be profitable. You can be profitable and have no cash. And if you're making decisions based on your bank balance, something will always feel off, because it is. The real risk, the real danger isn't messy books. It's clean books that are wrong. Because everything we just talked about doesn't usually break your financials. It just distorts them quietly. Everything looks fine, but your profit is wrong. And that means every decision you're making, pricing, hiring, inventory, and taxes, are based on bad information. So here's the baseline. You need to tie your payouts to platform reports, separate revenue from taxes, break out sales, fees, and refunds, match deposits properly, record cost of goods sold with sales, track inventory, apply consistent capitalization, review everything, not just automate it. This isn't advanced accounting. This is the minimum required to trust your numbers. Because if you don't trust your numbers, you can't trust your profit. And if you can't trust your profit, you can't confidently grow your business. You don't lose money because your business is broken. You lose money because your numbers are lying to you.